Hi, hello, namaste, hearty welcome to yet another interesting iLead Tax Talks. This is Nanda Kumar KV here. Sorry, I was busy with the phase 1 tax planning sessions with my client, so I couldn't come live for the last 2 weeks. My apologies for that. But I'm so happy for your love, for your encouragement, for your support, and for all the queries that we receive concerning this particular episode. I mean, this particular series. Yeah. So thank you very much for that. As I always say, 100 clients like you, they create one job for my student at iLead Tax Academy. So please support our initiative wherein we offer industry ready education to our students so that they get employed, and some of them they also become entrepreneurs. Okay, so thank you very much, and me and my team are extremely grateful for your business to iLead, whether through iLead Tax LLC or iLead Tax Academy. Thank you very much for that. Yeah. Well, so today we are going to section 3. Okay, real estate and then foreign assets. Now, this section covers home sales, capital gains, currency conversion, and section 121. Okay, these are the issues that create the largest single event tax bills for immigrants, so pay very close attention. Okay, if you have still not liked or subscribed to our video, please do like. And what we are going to learn in this video also, if you see, I have put the title, you sold your Canadian home tax free in Canada, but what did the IRS calculate? Is it tax free in USA too, right? Why Canada's principal residence exemption means nothing to the IRS? How Canadian or USD exchange rates can create a US taxable gain even when you broke even in Canada? Next, section 121, the US home sale exclusion that can apply to your Canadian home. Okay, so we are going to learn about all these elements one by one. Okay, sure. Now, let me start with the single biggest misconception, okay, that foreign home sales have. Canada has something called the Principal Residence Exemption, the PRE, okay? The PRE. It's a beautiful thing. If you lived in your home as your principal residence, you can sell it completely tax free in Canada. No capital gains tax, zero. Getting it? Zero. So, for many Canadians who bought homes in 2010 and sold in 2023, that's hundreds of thousands of dollars in tax free gain, right? Wonderful benefit, isn't it? Now, here's what every Canadian immigrant needs to hear. Now, Canada's tax exemption does not travel across the border. The IRS says, okay, Canada gave you an exemption, that's great, but now report that sale to the IRS. Report that sale to the IRS. I mean, this may be hurting. We are going to calculate the gain in US dollars. Okay. Now, we will also be applying section 121, the US home sale exclusion, and see how much of that gain we will allow you to exclude. So, this is what, IRS is going to tell you the moment you claim, those things. And whatever remains is taxable in the USA as per the IRS. Okay, so you can sell your home completely tax free in Canada and still owe US tax on the same transaction. Is that double taxation? No, because Canada taxed you zero. There's no Canadian tax to credit. And the US exemption, section 121, may or may not fully cover your USD denominated gain. Now, ask yourself, if you sold or you're planning to sell property outside the USA. Now, this is critical. This is critical. Okay. And if you have any questions, please do write to me. Ask Nanda at iLeadTax.com. Now, let me show you something that absolutely blows people's minds, when they first see it. The currency conversion problem. See here, if you see scenario A, currency reduces your US gain. You brought a home in Canada in 2008 for some 500,000 Canadian dollars. At that time, 1 Canadian dollars was worth 0.95 US dollars. So your USD basis was $475,000. In 2023, you sell that Canadian home for 800,000 Canadian dollars. But now 1 Canadian dollars is only worth 0.74 USD. Your USD proceeds are $592,000. Your Canadian gain was $300,000. So your USD gain is only $117,000. Okay, a little bit of maths here and there. Now, currency helped you here. With all due respect, the weaker the Canadian dollar reduced your US taxable gain significantly. Getting it? Now, here is scenario B, and this is the one that shocks people. You brought a home in Canada in 2010 for for 400,000 Canadian dollars. Now the Canadian to USD rate was some 0.72. Your USD basis was some 288,000. You sell in 2023 for exactly the same price. Yeah, a Canadian 400,000. So break even in Canada, zero gain in Canada, zero Canadian tax. But now 1 Canadian dollars is equal to 0.82 USD. 0.82 USD. Your USD proceeds 328,000. Your US capital gain $40,000 on a transaction where you made zero profit in Canada. So this is the currency conversion paradox. A break-even Canadian transaction can create a taxable US gain purely because of exchange rate movements. And this is why you cannot evaluate a foreign property sale without doing the USD conversion analysis first. So ensure this is taken care of before you sign the sale agreement. Let me say that again. You make zero profit in Canada. Zero. Zero. But you owe capital gains tax in the USA. That's the reality of cross-border real estate. Yeah, you may feel good about it. About having the property, in Canada, in US and all, but the tax implications and all, it is something I greatly encourage you to make a note of this. Yeah. Now, let me walk you through the US capital gains formula for a foreign property sale. Okay, step by step, simply. Some 5 steps I have listed here. So, step 1, take the sale price in foreign currency. So, even if you are accountants, I encourage you to do that. Peers in the industry, probably you can just review this and then email me also. Other CPAs or enrolled agents, you can email me if you want me to make videos on any topic, or you're getting any follow-up questions from your clients on what content I'm making here. Please do send an email to me. I'll be happy to make a video for you. Yeah. Now, so step 1, take the sale price in foreign currency. Convert it to USD using the exchange rate on the date of sale. That gives you your USD proceeds. Now, step 2, take your original purchase price in foreign currency, convert it to USD using the exchange rate on the date of purchase. On the date of purchase, okay? You can just rewind it in case you missed something, or turn on the captions button so that you get the captions on. So that gives you the USD basis. Notice two different exchange rates, two different dates. The gap between those rates is where the currency magic or the currency shock happens. Step 3, and any capital improvements you made to the property, like new kitchen, extension, major renovation, each improvement gets converted at the exchange rate on the date that improvement was made. So keep every receipt, every invoice. Then step 4, add eligible selling costs like real estate commission, legal fees, transfer fees, things like that. Again, converted at the applicable exchange rate. Remember that, okay? And then step 5, the resulting number is your US capital gain. I report that on Schedule D and Form 8949, subject to Section 121 analysis, subject to foreign tax credit analysis if any foreign tax was actually paid. Now, just ensure that you keep documentation of purchase agreement, closing documents, improvement receipts with dates, then sale agreement, settlement statement. If any of this are missing, people like us can help reconstruct, but it's harder and more expensive. Okay. Next, I want to reinforce here the currency conversion concept. Okay, with one more powerful example, because this is the one that changes how people think about foreign real estate. Okay, break even in Canada, taxable in USA. This is not a hypothetical statement. This happened to actual clients. And when they came to me and I showed them the USD calculation, they couldn't believe it. But Nanda, I didn't make any money. And I had to say, you didn't make money in Canadian dollars, but in US dollars, because of how currency moved, you did. Now, the reverse can also happen, which is the silver lining. A huge Canadian gain can look much smaller in USD terms if the Canadian dollars weakened between your purchase and the sale dates. Currency can help you or hurt you. The only way to know is to run the numbers before you sell. Okay. So, if you are planning to sell property abroad in the next 12 to 24 months, uh, I would suggest get in touch with people like us. Yeah. Next, section 121. Now, here is some good news, okay? And I love delivering good news whenever I can. Section 121 of the Internal Revenue Code, the home sale exclusion, it does not discriminate between US homes and foreign homes. See, if your Canadian income, if your Canadian home, Indian home, your home anywhere in the world, qualifies as a primary residence, you can potentially exclude up to $250,000 of gain if you are a single filer, or $500,000 if you are married filing jointly. Remember this. But, and this but is critical, you still have to meet the tests. The ownership test, you must have owned the home for at least 2 out of the 5 years immediately before the sale. Next, the use test. You must have used the home as your primary residence for at least 2 out of the 5 years immediately before the sale. Here is the timing trap also. If you move to the USA in mid 2022 and are selling your Canadian home in 2026, that's about 4 years after moving. Now, the 5-year look back window from the 2026 sale date goes back to 2021, right? So, you were living in Canada until mid 2022. So, that's about 18 months, okay, of the 5-year window. You meet the 2-year use test, but if you wait until 2028 to sell, the 5-year window goes back to 2023. So you haven't lived there since 2022. You may fail the use test. Getting? This is why timing of the sale is one of the most important planning decisions you can make. And why you need to think about this before you call the realtor. Yeah. Now, remember that section 121 is not automatic. You must claim it on form 8949 when reporting the sale. And if the sale is not reported at all, the IRS will have no knowledge of the exclusion claim also. So you must file the return, claim the exclusion. Okay? Both must happen. Both must happen. Remember that. Just a second. Now, let's check this. See, let's run actual numbers for Ajay. I love doing this because numbers tell the truth. Yeah. You see here purchase price, capital improvements, selling costs, sale price, adjusted basis, gross gain, section 121 exclusion, taxable gain, and all. Only technical people they may understand. If you are technical enough, you can also understand. Now, here the result is zero taxable gain after the section 121 MFJ exclusion. But and I need to emphasize this, the sale still must be reported on form 8949. The exclusion doesn't make the reporting obligation disappear. If Ajay had not reported the sale, the IRS would have seen a foreign property disposition with no corresponding return entry. That triggers questions. That triggers potential audits also. And notice the key planning element here. If Ajay had filed this return correctly and claimed a 121 election in time, he would have had zero US tax on this sale. The tragedy is that the failure to file cost him anxiety, professional fees, and the risk of penalties, not just the actual tax. Now, now, here is a fact about Ajay's situation that dramatically changed the calculation. See, Ajay only owned 1% of the Canadian home. His parents owned the other 99%. So, of the 300,000 Canadian dollars gain, only 3,000 Canadian dollars was attributable to Ajay. But, and this is the critical planning point, without written documentation of the ownership percentages, the IRS defaults to whatever it can reasonably infer. If Ajay's name is on the title as a joint holder with no documented percentage, the IRS could argue 50-50 or even 100%. 100%. If the documentation is unclear. Okay. And this is why family ownership arrangements need to be documented, proper, in writing, before the sale. A family meeting where everyone agrees verbally, that is invisible to the IRS. A properly documented title with clear ownership percentages. And that is defensible, okay? Now, for Indian families with joint property, ensure you get a lawyer to document ownership percentages, especially if a US person is on the title. This is also relevant for your FBAR and FATCA if the property generates rental income that flows through a foreign account. Take care of that. Next. See, in Ajay's specific case, 1% ownership, only 1%. His parents own 99%. The single fact dramatically reduced his US tax exposure, on the home sale. So instead of calculating section 121 on the full gain, only 1% of the gain needed to be reported on the US return, if you notice. But here's the lesson. Here's the lesson. Without the ownership documentation, this defense does not exist. Verbal family understanding, invisible to the IRS. But a title deed showing Ajay and parents with no ownership percentages, the IRS can argue equal allocation. Hence, the documentation is everything. Very important. Document. Now, here is one of the most counter initiative concepts in all of the cross border taxation, and I want you to really think about this one. See, Canada's principal residence exemption means Ajay pays zero Canadian tax on the home sale. Yes, zero. That sounds like a win. And Canada, it is a win. It is a win. But here is the problem for US tax purposes. The foreign tax credit allows you to credit taxes you actually paid to a foreign government against your US tax liability. It's designed to prevent double taxation. But if you paid zero Canadian tax, you have zero to credit against your US tax. So, the very benefit that made the Canadian home sale so attractive, the principal residence exemption, also removes the foreign tax credit protection that would have reduced your US tax. It's a double edged sword. I call this the tax free paradox. Sometimes paying tax abroad is actually better for your overall global tax position, than paying nothing. Because foreign taxes paid create a credit that reduces US tax. So, the interaction between foreign exemptions and the US foreign tax credit is one of the most sophisticated concepts in international tax planning. I know this sounds like I'm telling you that paying tax is a good thing. In this specific context, yes, sometimes it is. That's how complex cross-border planning gets. Now, uh, now 2022 was Ajay's most complicated tax year by far, and I want to spend a few minutes on this because remote work situations, which became incredibly common after 2020, create a very specific set of tax complications. See, Ajay relocated to New Jersey in, say, March 2022, but he continued working for his Canadian employer remotely from New Jersey for approximately 2 months after arriving. Now, here is the issue. Employment income is taxed where the work is physically performed. Getting it? I repeat. Employment income is taxed where the work is physically performed, not where the employer is located. So, that 2 months of work performed from New Jersey while being paid by a Canadian employer is US source income, subject to US tax, period. On top of that, 2022 is a split year. He was a non resident alien for part of the year, the months before arriving in the USA. He became a resident alien for the rest. So these are two different tax filing statuses with different rules, different deductions available, and different treaty interactions also. Now, a question arises about dual status tax return, which is what 2022 likely required. It's one of the most complex individual returns in the US tax system. Now, standard tax software like TurboTax or anything else they handle it poorly. Most local CPAs have never prepared one, so there's a specialist document. See, remote work across borders, including Indians on H1B working remotely for US companies while visiting India, also it creates similar sourcing complexity. Okay. If you are the Indian audience, I wanted to specifically highlight this, so that you keep this thing in mind. Okay. So, having said this, we have now covered the home sale, the currency conversion shock, the section 121, and the foreign tax credit paradox. You now understand why Ajay's situation was so complex. But here's what we haven't answered yet. What can he do about it? What are the actual problems or solutions the IRS offers for people in this situation? What is streamlined filing? What is reasonable cost? And why did Ajay choose not to be streamlined? So in episode 4, our final episode, we cover everything about getting into compliance. So the 8-step action plan, why timing matters, and what iLead Tax LLC can do for you right now. This is the episode where I give you the roadmap, okay? The exact steps in the right order. So don't miss it. Subscribe, share the video right now with someone who has foreign accounts or foreign property, and I'll see you soon in episode 4. And before that, I also want to talk about the phase 1 tax planning. I mean, many people they feel that they don't get refunded at the year end, or they are paying taxes, they pay estimated tax penalty and all. With all due respect, let me tell you that there's no magic wind in any EA or CPA ad. Kitta bhi experience rehne do. The sooner you approach them, the better it is for you. You can always explore. See, at iLead, we make it very, very reasonable because I'm creating employment for my students in India. We work with corporates and so many finance heads, decision makers. They support our vision, they like our model. You go to YouTube, type iLead Tax Nanda Kumar TV9. You will see me on most of the news channels in India. And they've complimented me for creating employment. Some news channels have also titled me Indian for Indians in the USA. So all this happens, because of your love and support only. But at the same time, I love you if you plan your taxes. Though not with iLead, somewhere, wherever you're comfortable. I make so many videos for you. Making videos is not that easy, nor am I doing it, for any formality. I don't get paid for doing the video. You get benefited. Watch it, even if you don't understand, please do watch it once or twice. Now we have so many AI tools and all, you can extract the summary. YouTube directly gives you the summary of that. You can paste those things, in any other AI tool of your choice and ask more questions. At least, I mean, we don't charge you a bomb, as I said. I just charge like $60. That's all for a 60-minute conversation. And once in 6 months, if $10 per month is not heavy on your pockets, I definitely encourage you to seek iLead. And if you're getting, somebody else, who is offering very premium, tax planning solutions, I definitely want you to explore that. As your income is increasing, I definitely want you to invest into planning. I always keep telling my clients, review your iLead. Income, liabilities, expenses, assets, dreams. And today, you must never go back on spending or investing. I would not say spending, investing when talking to lawyers, doctors, accountants, fitness coaches, and if you believe in God, spiritual gurus. No, you don't believe in God? Some business leaders, business mentors. I tell you, you will definitely have some key takeaways from them. Please don't waste your time anymore. I'm making this video on June 13th at 9 p.m. in the night. We still have some 17 days left. So if you have still not done anything on your tax planning, just shoot an email to me or call up my office. You have all the numbers listed here, whether you're from India or from USA. Get in touch with us and we will be happy to help you. Yeah. Take care. Love you very much. See you soon in episode 4. Bye bye.